Hey guys, welcome back to the show. I am so glad you guys are here. As you can probably tell, I am not in my normal, not in the normal place that I would video this. We're actually traveling. We're in Ohio visiting friends and grandchildren. But I did not want to miss out on the opportunity to meet with you guys and just talk about dividend stocks for a little while. I mean, we may go the full hour, we may go only a half hour. I mean, I know the Monday night football game's going on, but I mean, what more could you want than to talk about dividend stocks? Anyway, let's go ahead and get started. So, first of all, let me know in the comments who your biggest performing stock was today. I think that would be interesting to know and to find out. So, if you could leave me a little comment about that. Also, a couple of thoughts on the last video that I did. So there was a little glitch in the audio, and so first of all, the audio was a little bit. It sounded like I was in a well, and it was all my fault. I mean, I had left the stinking microphone way over here instead of putting it right here. But I didn't realize it until after it was done. It was late in at night, and we were leaving early the next morning. I just didn't have a chance to re-record it. So, it is what it is. So enjoy it. The content I think is good. Maybe the sound quality not so much. So anyway, I appreciate you guys suffering through that video. And then the second thing is that I got a lot of comments on the video regarding cash. And so when I was referring to cash, my assumption was that the cash we were talking about was the cash inside your portfolio. There was a lot of questions about emergency funds and if you're saving up for, you know, a property tax bill or an insurance bill that comes once every 6 months or something like that, then obviously you need cash for that. I call that really operating cash, not investing cash. So I don't invest if I've got, let's say I pay property taxes every year, and if I'm saving up my property taxes every month, I don't invest that cash. I mean, it's getting interest from a savings account or checking account, but I'm not investing it in the stock market, and I wouldn't recommend that really anybody do that. So the cash that I was talking about was just inside the portfolio. So just wanted to kind of clear that up. So if there's any question on what kind of cash I was talking about, so I was not advocating that we have zero cash at all. We need cash to run our lives. So anyway, that's the lowdown on that. I'd like to. Looks like I got a couple of folks in here. We got 12 on the stream so far. We've got Pat. Pat has his biggest performers were THD, ADCO, and AbbVie, Realty Income. So yeah, those are good. Those are good ones. And we got Kevin Mendoza who says, "Good evening, Kevin." So yeah, so and then he also says that the audio in the last video was a bit different, but he still enjoyed it. So I appreciate that, Kevin. And that was really just that was my fault. I just forgot to pull a microphone over. When you get old, like I am, and you're retired, things like that happen, and you just roll with the punches. You know what I mean? So that's kind of where we are. And we got Punisher 66 here. I don't think I've seen your letters here before, so I appreciate you showing up, my friend. And I'm glad you like the content. It means a lot to me, really. We got Clayton. Clayton says his big performers are Lowe's, Realty Income, SCHD, and Main Street Capital. So those are all fantastic stocks to be in. So before we kind of get into the program, I wanted to share with you the content for tonight. That content for tonight is about the interest coverage ratio. So some people call it the ICR. So let's go through that really quick. This is going to be a pretty quick one. It's a pretty simple concept, but it's really one that we need to understand, as investors. So let's go to, I'm going to share this screen and hopefully now I am since I'm traveling, I only have one monitor. So while I'm in this particular mode, I can't see any of your comments. So I'll catch you on the other side. So let's just go through these slides. Hopefully they're showing up. So our dividend gold, unveiling winning metrics. Number 4 is the interest coverage ratio. So let's move along. The formula for this is they take the earnings before interest and taxes. So they basically take net income, add taxes back, and add interest back. And what you get is a number that is pre-interest and pre-tax. So then they divide that number by the interest expense. And you know what we get? We get a number that tells us how many times earnings covers the interest expense. So what that really means is the lower the number, the more the company may struggle to cover the service cost of their debt. And so that means that they only have a small number of earnings compared to their interest expense. And if they have a high number, that means that their earnings can cover interest expense multiple times over. So if a company has, 20 times, so if the ICR is 20, that means that their earnings can cover interest expense 20 times. That's a great number. If it is 2, that's not such a great number. So I guess the way I think about it is if it is 8 or below, I need to dig further. I mean, like every metric that we've talked about, there's no one metric that is like the king metric. I mean, they all play together. So I need to look further. If it's above 8, then I recognize that they are pretty well able to service their debt and that their debt load is not overtaxing to the company. So, oh yeah, here's the other point that I put on the slide here. Companies with debt will have an ICR even if their net debt is 0. So, a lot of companies that we see will have net debt of 0. That means that they may have debt on their books, but they have at least as much cash on their books. So net debt is really the debt minus cash. So if they have net debt of 0, but yet they still have some debt and it's covered by cash, they will still have an an interest coverage ratio. So that's important to remember. So I thought I would just throw that on here as well. Okay, we got a question from John J that I want to kind of give my thoughts on, and I'm not sure if I'm going to do this justice or not, but let me just read the question to you. He says, "Hey, great educational videos. I appreciate that, John, very much." He says, "We would be interested to have your take on a live show or a more detailed topic, which would be the time value of money and investment time horizon." And he goes on to further define that by saying, as many others like you that are retired or that are either retired with sizable investments to protect and that rely on dividend income or capital gains to partly finance their retirement, even many younger people who retire early with this FIRE movement, how should so here's the question: how should their investment be diversified to last 30 to 50 years or stand the test of time? And he says, of course, we know this is just your opinion and not professional advice. That is exactly right. Any advice that I give here is just my personal opinion. Most of the time, I will just tell you what I do, and that way, it is what it is. I'm not. I don't really know every possible combination of things. I just know what I do, and I'm happy to share that with you. So I guess the way that I would look at that, I put a couple of slides together on this. So first of all, this really is around the area of portfolio management. So when you think about, hey, I've got a portfolio and I want it to last 30 to 50 years, the question is, how am I going to manage that portfolio to last 30 to 50 years, right? So I would say the first thing that I do is I try to avoid yield traps. And that might be a subject for maybe our next live stream, is what is a yield trap? Because it takes a little while to describe. But, basically a yield trap is when a company pays a lot of dividends, but yet is not running a very good business, and the overall price of those shares goes down. So you might end up with an overall return that's negative, even though you're getting a lot of dividend interest. That would be a yield trap. We don't want that. If you're a 30 to 50-year time horizon, you want your portfolio to be growing if you possibly can. So avoid yield traps is number one. And these are off the top of my head. And I would say the second thing, if you're out there for 30 to 50 years, I would think you would want to seek some growth. Not just buying bonds, for instance. Bonds would give you an interest rate or a bond payment, but it wouldn't necessarily grow your portfolio. I guess if interest rates came down, you could argue that it would. But just to be simple, you would get the bond interest every 6 months if you bought a bond. So that would not be something that you would want to do if you're looking at a 30 to 50-year horizon and you're like me, having retired already. So you're not really contributing every week, every month, every quarter to your portfolio. I think the third thing that I would say is you want to seek dividend growth that would be greater than inflation. So as inflation grows, let's say, the past couple of years, it's been, 7.5% or even more than that at times. It was 9.3 at one time. So you're going to want dividend growth that, at least in the long run, is greater than inflation, because if you are living on those dividends, you want those dividends growing at least by the amount that your expenses are growing. So I think that's item number 3. Number 4 is to hold cash commensurate with your portfolio style. Now, what do I mean by that? And this is a bit complicated, but I'm going to go through these. If you use only dividends, if you only use your dividends sporadically, and that's kind of the way it is for me. I have streams of income that I actually depend on, and then I will reach in and grab dividends as I need it, as I'm doing things that would cause me to need some additional funds. Then it may not be necessary to hold a lot of cash, because it's just I'm depending on these other funds. If I'm living off dividends only, then it might be worthwhile to have some cash. Maybe that's 1 month or 2 months of cash, just in case you've got some, a quarter, or I'm sorry, a month in the quarter where you've got a lot of dividends, and then other 2 months are very short in dividends. Because if you are trying to balance that out with selling shares and the market is down, you're going to be eroding your portfolio, and you don't really want that. You want to be able to just grab that cash. So maybe you would need 1 or 2 months of cash if your portfolio is one where you're living off your dividends only. Another one is they will draw down a percentage of the portfolio each year. One of the most popular ones is like a 4%. So they will say, hey, if I draw down 4% of my portfolio a year, it should last me for 25 years. Right. So that would be one approach. And if you're doing that, I would suggest having maybe 1 to 2 years of cash sitting back, because you don't know how long these recessions are going to last in the market. The market may be down, and you would be forced to sell off shares at a lower value. And therefore, even if you were saying, hey, I'm going to sell off 4%, you either get 4%, which would be then a much lower amount, and you have to adjust your expenses. Or if you say, I need a certain amount of money, you're actually selling more of your portfolio than the 4% that you thought you were going to sell. So I would keep the point of that is hold cash that matches the way you're managing your portfolio. And then I think that's it. So those are my thoughts on that. I will stop sharing this and see if there's any comments on that. Let me get back to where you guys are. So anyway, any thoughts or comments on that? I'd be glad to address that here in the live stream. And also, if you guys, want to just ask questions in general, um, I think that would be that'd be appropriate now. So we're about at 8:15, and I'll stay on here as long as you want. I'm gonna certainly cut it off around an hour. But if we run out of questions before that, I'm certainly good to go back and watch some Monday Night Football game as well. But I did want to get on here with you guys. I missed this interaction, so I'm really glad you guys are here. So let's get started. So we've got Kevin Rayberg, who says that his best gainers were 3M and Realty Income. His biggest loser was Intel. So yeah, I can certainly see that. Jim Tyson was up 3.36% today. That's really good. Of course, you have to weather the the declines that you've had up to this point. So let's see. Jim says 100 likes and Kevin will rip out 10 reps of 225 squats on the power rack. You got that right, my friend. You can tell that I am not at my house because that looks like serious business back there. And anyway, I'm sure I could get somebody to come down here and run those reps for me if I need to. Let's see. MPW was his best at up 2.69%. That's good. They needed some they needed some comeback, right? So that's good. I'm glad to hear that they have made a little bit of a move today. Let's see. I'm thinking about buying Lind Corp. I think that is it's a competitor to Air Products. What do you think about this one, Kevin? So Kevin Mendoza, I think Lind is a great company. I've looked at them. It was either Lind or Air Products for me. And why don't we just go look at it instead of me just talking about it? But since I only have one monitor tonight, I've got to do some things that are a little different. So I'm going to share this. I'm going to go to here and we're going to pull up. This is Simply Safe Dividends. And let me ask you guys if you saw Ari Gutman's interview of the guy who was the founder of Simply Safe Dividends. I thought that was a fantastic interview. And I thought he did a really good job on that. If you guys could go out and watch that and comment on it, I thought it was phenomenal. He did a really good job. All right, yeah, so they're in industrial gases, just like Air Products. It's the materials sector. Their dividend yield is 1.25%. Dividend safety is 99. They are absolutely killing it on the safety side. Let's move down. They're around $407 a share. Let's look at their dividend growth. So in February 23, they grew their dividend by 9%. They've averaged 8% over the last 5 years, which is really good. And they've averaged 13% over 20 years. Guys, that is really good. You know what I'm going to do? I've already done that. So let me take Kevin off and yeah, I like that. I think that's the way we're going to leave it. So now how do I get back? Okay, here we go. I think you can see it now. So then they've got a dividend growth streak at 30 years, uninterrupted dividend streak of 30 years. They, let's see, from a dividend yield perspective, it is lower. That means that they could be overvalued at this point, according to Simply Safe Dividends. We'll go over and look at what Morningstar says here in a moment. Their PE ratio, though, is pretty consistent with their 5-year average. So I would say that they're probably more fairly valued than overvalued. Let's take a look at their payout ratio. Look at that. They need to raise this dividend up because their payout ratio is down in the low 30s now. So that's fantastic. Their free cash flow payout ratio looks really good. Let's go to, it looks like they issued a lot of shares. They must have acquired a company back in 2019, but they have been buying back some of those shares since then. Their return on invested capital has grown to up over 14%. So that is really good. And this is one of the first metrics we looked at was return on invested capital. And one of the caveats that we had on that was that sometimes you buy companies that have a low return on invested capital because it gives the management team a lot of room to grow the profits of the business. Looks like that's what's been going on here. So they've done a really good job on that. They've got about a 26% debt load, and their interest coverage ratio. Let's take a look at that. I mean, that's what this is right here. So the subject of tonight's class was on interest coverage, and you can see here above 8 is our preference, and that's what we talked about earlier. Lend is 25, so that is more than adequate. So they are well capable of handling their debt load. So I see nothing in these numbers that causes any concern for me at all. Let's go to Morningstar. Let's look at LIN. And let's go down to this. Hopefully, you still have me. Let me go check. Yeah, I see it. It's good. So they have a fair value at 393. This is the main reason I picked Air Products over Lin was the fair value. So they're saying that they're at fair value, which is what we talked about earlier. They look to be about fair value. So it's that old adage from Warren. Well, actually, from what I hear, it came from Charlie Munger to Warren Buffett, where he said, sometimes you got to forget about this margin of safety and you got to pay a fair price for a great company, because sometimes paying a great price for a fair company just isn't as good. So, and I am that's my kind of take on that. I'm sure that it went a lot different than that, but that's I'm using my editor's license on that. So anyway, fair value 393 is what they say. It is at 406. I would probably wait a little bit and see if I could get it down some closer to fair value. But if you are set on buying Lind, I think it's Lind or Lindy, then I would say go for it, my friend, because it looks pretty good to me. Let me see where I am here. Oh, I took you off the screen. That's why I can't see you anymore. All right, let's move on. I'm going to get rid of this. There we go. Oh, I'm back. Hey guys. So I will never sell shares. I have a rule of just pulling 75% of dividends and reinvest the rest. That's a great rule, Pat. I like that. That means that you are living off of your dividends or whatever cash, if you've got real estate or any other, pensions or Social Security or whatever other income you have. And I think that's a great rule. So sometimes you may even reinvest more than the 25%. But I like that rule a lot. All right, so let's go to Greg. Greg says, curious about buying PHM for a while. Not exactly a big dividend, but with rates possibly going down next year, it may be something to look at. So let's go take a look at PHM. And I think I am still sharing. Yes. So now let me get to that screen. PHM. Let's see what Simply Safe Dividend says about that. So that is Pulte Group. I don't think I've ever heard of that. So consumer discretionary home building. They have a small dividend, 0.88%. Their dividend safety is considered borderline. That doesn't cause a problem. I mean, I've got stocks, and I'll show you one here in a little bit that are borderline safe. It's just, you just need to know it, right? You need to know that going in, and it really doesn't say, at least I've not found where they give a write-up on why they consider it borderline safe. We just have to look at the numbers and try to determine that ourselves. But they reaffirmed it on November the 7th. Let's see. They have a looks like in the 2009 to 12 time frame, they didn't pay a dividend at all. So they had cut the dividend actually completely and then reinstated it. So they actually grew the dividend this year by 25%. That is pretty huge. That gets their 5-year CAGR to 11%, which is a nice 5-year CAGR. Then they've got a 14% over a 20-year, which also includes these zeros. So they've got a pretty nice 20-year growth rate too. It's just pretty volatile. See if there's anything else here that's kind of cool. Looks like they're pretty fairly valued from Simply Safe's perspective. Wow, this payout ratio is only 7%. That looks enticing. I don't see where they pay a special dividend at all. So they do pay a very small dividend. So I would look at this really more as a growth stock than as a dividend growth stock, because they don't appear to be growing the dividend very. They're growing it fast from a percentage perspective, but it's very small compared to what they're able to pay. So, they're going 14 cents, 15 cents, 16 cents. Now they jump to 20 cents, which is good. And, don't get me wrong, but 20 cents off of a stock price of $91 is not a very high percentage. So, there must be something more that investors are looking at other than the dividend to drive their value. So that's kind of the way I look at it. Their free cash flow payout looks great. Their return on invested capital is in the high 20s, so that's fantastic. And net debt is very low. Interest coverage is right above that 8 mark. So that that's pretty close. But I think that's still fine. So it looks like a pretty decent stock to me. And I think the debt piece is what is driving this, because everything else looks pretty good to me. So let's look and see what PHM. So let's see what Morningstar says about this. Oh, they don't cover it. So they have a quantitative number that they say is 90, let's say $99 is a fair value. I don't trust those very much. So unfortunately, Morningstar's not going to add much to the conversation on here. But overall, I think it looks like a pretty decent stock. But I would need to dig in. Home building is probably not the greatest area right now as we look at the future. I do believe that there's still a shortage of houses, but I don't know that there's going to be a lot of people that can afford the interest rates to get in them. So, but we'll just see. We'll have to see what happens. So you'll have to kind of look at that market and see what you think about that moving forward. Let's see. Go back to here. And let's move on. Let's look at Jim. Jim says, great info on the portfolio management. Even having been retired for a couple of years, the pointers are still solid. The only thing I would add as you get close to retirement age is diversification. That's a great point, Jim. And diversification is really important. And what Jim's talking about is that we want to have a portfolio that gives us everything that we want from it, but we're diversifying risk. So if I invest in one stock and something happens to that stock, whether it's related to the market or the economy, or whether management does something stupid and causes the share price to drop and then they stop paying dividends or whatever, and I only own that one stock, all of my hope is in that one stock. But if I have 20 stocks and they're each 5% of my portfolio, instead of getting impacted by 100% by having only that stock, I now will have 20 stocks at 5% of my portfolio to get to 100%. And so it's only impacting me by 5%. So I can sleep better at night with diversification. And Jim makes a great point there. Kevin says, thank you. And you are welcome, my friend. Jim says, I just watched Ari's video before your live stream, and it was a great video. I've enjoyed that whole series he's done on his channel. I have too. I told Ari that, of course, we spent a lot of time together because I think I was on like 3 or 4 of those. And I told him that he does a great job of asking questions. I mean, the questions that he asks are very pertinent, they're very timely. So if you haven't watched that video, I would highly, highly recommend it. So yeah, Greg, it's a home builder. That's right. And you're talking about PHM, and so we'll just have to see what the future holds, and eventually home building will come back. I just don't know when that is. So Derek says he's planning to watch Ari, but you were live, so I jumped in late and 2x speed to get caught up. That's fantastic, my friend. It's probably better at 2x speed, by the way. Not until interest rates go down. Yeah, that's right, Greg. 100% agree with you on that. Dresh, what is on your watch list this week? That's a great question, because you know what? The market has gone up, and all the stocks that were on my watch list are like going up. I will tell you, I did sell some shares last week, though. I didn't put that on the video. I should have. I trimmed some of my IBM shares, and I was really surprised to see it continue to go up. But I was at 3.5% of my portfolio because it had gone up so much. I want it to be around 2.5%, so I sold enough shares for it to be back down to around 2.5%. But it's still going up, so that's a great thing. Let me go to this, and I will show you some things that are on my. Whoops, add to the stage. There we go. Now let me get back over to this window. It is much easier when I have multiple monitors. It's just because I'm not used to this layout. So let me pull this up. No, let's go here. We're going to go to Morningstar. We're going to pull up my portfolio, and these are some benchmarks that I look at, but this is my portfolio here. Let's go into my view. So for the day, it might be interesting to see what grew the most for me today, and that is Cummins. Cummins was up 2.15%. Let me see. It is 4.4% of my portfolio. Lowe's was up 1.78%. Realty Income was up 1.7%, and Kilroy was up 1.64%. So those were all good. Texas Instruments went up a bit. Let's see what drug me down. Whirlpool drug me down again at 1.54. Microsoft drug me down, and that is the largest holding that I have is Microsoft, I think. Maybe Cummins passed it. Yeah, it looks like Cummins passed it. It's now 4.43, and Microsoft is 4.28. So guess what? I've got a new number one, and that is Cummins instead of Microsoft. So, but Microsoft is a big number in my portfolio. So when it goes down 1.4%, it's a little hard to recover from that. But overall for the day, I was down 0.03%, as you see here. Is there anything else worth sharing here? So what's on my watch list for this week? What was on there for last week was U.S. Bank Corp, and they have gone up significantly in the past week. So they're up around 39. My average cost, let's look for that. Average cost is around $33.93. And that wasn't that long ago. I've not been buying them for long. They are currently 2.2% of the portfolio. I do want to get them a little higher than that. But, right now I'm not buying them at 40. I'm going to wait, and hopefully they come back down. And if they do, I'll pick up some more shares. So U.S. Bank Corp was one that I was looking at. RTX, let me sort this by ticker so that I can find them faster. RTX was another one. It's up 0.98%. It's trading around $83 a share. My cost is $74 a share. So that's a little bit pricey for me at the moment. And so, with the market going up so much, what I'm doing is I'm kind of waiting. I'm not jumping in and trying to catch that wave. I'm thinking that in December, and this is where I get in trouble, is starting to think, right? But I'm thinking that in December we're going to see a bit of a decline. I was watching a video from Morningstar this morning, and they said they thought the Santa Claus rally has already occurred. So we will see. This is not investment advice. I am just a guy just like you guys are, but that's kind of what I'm thinking. I think we're going to see a bit of a pullback. And then my other one was, what was my other one? CME was the other one, and it also has been growing. I do want to add more of this because it is, I think it's a good stock to own in a high income portfolio because of the year-end dividend. It is weird though because they only pay once a year. I mean, they have a quarterly dividend, but it's kind of small. Then they have the special dividend at the end of the year. But it's having a little bit of it. I don't think is too terrible. So let's go to the valuation tab. And again, what this tells me is based on Morningstar's fair value, where does the current price sit in relation to that? The most undervalued stock still is Kilroy Realty. And I don't know why that's so hard for me to say, but Kilroy Realty is currently trading around 36. I have it at just under $30, and it's a little too hot for me right now. I'd like to see it drop back a bit. Medtronic, that may be one that's on my watch list. I know I mentioned it last week, and I've mentioned it to several people. There's been a write-up by Simply Safe Dividends, and it may be time to pick up some Medtronic. They are currently, let me find it. Oh, there it is. They're currently 29% undervalued according to Morningstar. And then Whirlpool is one, but I am at this point, I'm not adding more to Whirlpool. I've got some Whirlpool in a taxable account, which means that I may actually sell that as a tax loss harvest. It's a very small piece of my Whirlpool, but I may do that because I've sold some shares at a gain. So I looked at it today. I've got about $10,000 of capital gains, realized gains that I've gathered in sales this year and selling some shares. So I need to try to generate some losses to offset that if I can. And realty income is still low. I don't have a ton of that. I've got 0.46% of that, but you can see RTX is sitting here at about a 26% undervalued. US Bancorp still 24% undervalued. So those are kind of the stocks that I'm looking at. And I know that's a lot. That's a lot of stocks. But to be honest with you, I have not seen anything that I am just saying I've got to buy this week. I'm just kind of waiting, and I know I've got this 7.5% cash value in my portfolio that I shared on that video, but I just don't see anything that I'm willing to pull the trigger on at the moment. So hopefully that's helpful. Okay, Eli, what's up, my friend? Are you pumping weights? Absolutely not. Not pumping weights. I'm, here visiting some friends, and he doesn't pump weights either, but he's got some teenage boys who play basketball and stuff. And I don't know if they really pump weights back here or if it's just for looks, but that's kind of where we're at, my friend. So Kevin says IBM was featured on 60 Minutes, highlighting their quantum computer. Well, that's good to know. I know that they've got that IBM Blue, which is their collaboration on AI. I forget who that's with. They're collaborating with someone. And so I know that's going on. Someone mentioned this morning that they had, restructured their pension retirement obligations. So that could be a part of it. But they just keep going up. And, this seems to be overvalued to me. As a matter of fact, wow, you can't see me. You can only see the screen. Is that better? Probably not. You want to see the screen, don't you? So let me go back to it because I do want to show something. Whoops, that's the wrong one. Okay, so if we go to the so for instance, on these are my most undervalued stocks. These are at the top. The ones at the bottom of this report are my most overvalued stocks, according to Morningstar. And you'll see here that IBM is currently at 128% of fair value. Morningstar says their fair value is 126. That's about what my cost basis is. And they're currently trading at 161. So, that's good. But it's kind of confusing too. Let's see. Let me come back here. Okay. Jim, kiss. Keep it simple. Stupid or sweetheart? I'm not really sure which one that is, Jim. Marry, kill, Seeking Alpha, Morningstar, Simply Safe Dividends. So I think you're asking, how many of these apps do we really need? And I'll tell you though that I use Simply Safe Dividends. First of all, I think it's got probably the most the word that I'm looking for is probably most objective information. And after listening to that guy today, I understand where that's coming from. And then the second thing that I use is Morningstar, because I think Morningstar's analysis and their fair value calculations give me a whole other sense. So, if I'm only limited to two apps, it would probably be those two: Simply Safe Dividends and Morningstar. Those are the two that I use. But I do also use Seeking Alpha, and I do use Tip Ranks, and I think there's another one that I use. I just can't remember what it is. So let me know, Jim, if that's what you were getting at. But those are my thoughts on it. All right, Kevin, my friend, thoughts on ICE, Intercontinental Exchange, as a dividend play? Well, let's take a look at it. See if I can get to it here. Oh, let me first of all do this. Get rid of this. Maybe you guys can see that. And then we will get where I can get to it, which is here. Okay, so let's go to Simply Safe Dividends, ICE, their Continental Exchange. It's a 1.46% dividend yield with a very safe dividend rating. They scored at an 89. It's about $115 a share. Let's look at some other stuff here. I like to look at this dividend growth. Their latest was 11%. Over the last 5 years, it's been a 14% growth on average. So that's really good. Yeah, there's nothing there that looks odd. According to Simply Safe, it looks like they may be a little bit undervalued. They've got a dividend yield that's a little higher than their 5-year average, and their 5-year average PE ratio is a little lower than the 5-year average. So those are looking good. Payout ratio 30%, the same on the free cash flow. That's good. Look at the earnings per share just growing up and to the right. Free cash flow per share is growing. Shares outstanding, that looks pretty decent. Return on invested capital is a little bit low. I would want to look into that a little bit, but it's not anything that would cause me not to invest in it. So net debt to capital looks like they got a pretty high debt load. They're about 47% of their capital structure is debt, and their interest coverage ratio is only 5. So they're a little bit debt heavy from my perspective. But again, it's not anything that's insurmountable. It's something that you would want to understand why they're that way. Maybe listen to some earnings calls, listen to the financial questions that they get. So let's move on then to this Morningstar, and let's look for ICE. I think that was it. Their Continental Exchange. Yeah, so they say their fair value is at 136. They're currently trading at a 15% discount. So, it may be something that I want to put on my watch list, actually. It may be comparable to the CME that I'm looking at in terms of the market that it's in. So, hey, that actually looks pretty decent. So, let me get back over here. There we go. So, yeah, Kevin, that's it. Actually looks like a pretty good stock. I mean, have you bought any of that? That was, a question that I would want to have for you is, have you bought any of that? And is that something that you're looking at? I like it. You know, Greg says he's asking which one of the three would you marry, which to kiss on a warm summer's night, and which one would you take to the pasture and never see again? Oh, that is great. Let me come back to that with that lens. So, which one would I kiss? Which one would I marry? And which one would I send to pasture? I would probably kiss Morningstar. I would probably marry Simply Safe Dividends, and I would probably kill Seeking Alpha. If those were my only three choices, that would be the way I would go at it. So I appreciate you, Greg, helping me understand that. All right. So we got Mr. Redcliffe. Hey, welcome to the show, my friend. What do you think of MCHP? Well, let's go check it out. MCHP. I'm not sure that is familiar to me, but let's take a look. And again, sorry for having to kind of fiddle through these screens, but let's look at MCHP. Microchip Technology Incorporated. Looks like it's got a borderline safe dividend. It's about a 2% yield. They are growing it pretty fast, though. Look at that. Their latest increase was 39%. That's incredible. Maybe I should take me off this screen if that would help you guys see it better. I'll take your comment off, and then, yeah, we'll just do that. That way you can see everything that I'm seeing on this other screen. Let's take a look at dividend growth. Their last 5 years. Wow, look at this. It has really shot up the last couple of years. Their 5-year CAGR is 12%. Let's see. They may be undervalued according to this. Their dividend yield is a little higher than their 5-year average. Their PE ratio is a little higher than their 5-year average. So it's kind of a mixed bag there. It looks like they may be expensive from a PE ratio perspective, but maybe inexpensive from a dividend yield perspective. Earnings payout ratio looks great. What do we have here? Return on invested capital is at 26%. That looks phenomenal. Net debt to capital is, it's pretty high up there. It's around the, 50% range. And their interest coverage, though, is way up. It's around, back here in 2019, 2021, even 22, they were below that 8 threshold. But now they've jumped to 15 and now even 18 on their interest coverage ratio. So that's pretty good as well. Let's jump over here and see what Morningstar says, MCHP. So Microchip Technology. They give it a fair value of 90. It's currently trading around 84. So they consider it fair value. It's about probably $5 below their fair value price, but it's still within that range of fair value. So, it looks pretty decent to me. So, Mr. Radcliffe, I think you're onto something. I think that looks pretty decent. Yes, sir. No problem, Kevin. And that is great. It's on your watch list. So Jim says, yeah, we're on the same page. You said you liked the CEO of Simply Safe, had to say, and really liked Morningstar. Seeking Alpha may be a no-go when it comes to renew next summer. Yeah, I think that's right, Jim. And kind of the way I look at it is, I can't own them all, right? But Seeking Alpha is something that does offer some of its product for free. So, if you want to go and buy one and then, use the free part of Seeking Alpha, I think that's maybe a win-win. So those are my thoughts on it. I'm looking in the camera, but I'm not even on the screen. So pretend like I looked at you, Jim. Okay. Okay, Greg says the recent run up has me a little worried. Yeah, I've got that on a lot of my stocks. So I'm waiting for a bit to jump into individual stocks for now. Just DCAing into my ETFs for the rest of the month. I think that's a great approach, and that may be part of what I do as well. I've got this cash sitting there. There are a couple of other companies that I'm looking to trim back a bit, and I won't share those at this point because I'm not really sure yet. Because at the end of the day, I've got 33 holdings, I think. Let's take a look. See how many holdings I've got. Oh, first I got to get you guys there. There we go. Fantastic. It's working great. Let's go to my portfolio here. Portfolio total. Yeah, so I have 33 holdings. 2 of those are ETFs, and so I'm looking maybe to get this down around 25. I'm not going to do that, in one fell swoop. It'll be one stock at a time, but I do want to get these holdings down a bit. I think we can get good diversification at 25 stocks. I don't have to be at 40 or 50. And as you know, when I kind of started this process, I had 42, and now I'm down to 33. So I have gotten rid of 9 holdings, which makes my quarterly work a lot less too. There's 9 companies that I don't need to listen to earnings calls for, and that kind of thing. So I'm excited about that. I don't know exactly which of these would go down if I were to get this down to 25, but there are some that I have an idea. But again, I'm gonna hold that for a different time. All right, where are we at here? Oh yeah, good job. You're up almost 9% on MCHP. That's fantastic. And Mr. Redcliffe wants to know if I can look at DDS. I think that's Discover. So yeah, why not? Let's take a look at that. We've got about 8 minutes left to end the broadcast, so we might as well do something while we're here. Otherwise, it wouldn't be fun. So let's look at DDS. Oh, that's Dillard's. Huh. Yeah, I'm not much into retail, especially clothing. So it's unrated. That means that it doesn't mean it's bad. This means they don't cover it. Their dividend yield is only 0.27, and they do have a pretty fast dividend growth, but it is not covered by Simply Safe Dividends. They do have special payouts though. Looks like they've got an ex-dividend date on the 14th, which is 10 days from now, for $20. That's pretty big. Let's see what their price is. Their price is $368. So so what is that? That's about 5%, a little less than 5%, a little more than 5%, I guess, of a special dividend. So if you're looking to get a dividend, then that might be something to buy into. That payout day would be on January the 8th. Do recognize, though, that when companies like that pay a special dividend, CME is in the same boat. Their share price will go down the very day that that ex dividend happens. And the rationale behind that is that the dividend would go with the previous owner, not with the future owner of those shares. However, I've found, at least in my history, that the value of the company doesn't get impacted downward very long. And there's some, rationale behind that I will share maybe on a different video. But so I wouldn't be overly concerned about this, but do recognize that on December the 14th, you can expect DDS shares to drop probably by $20. And we'll see what happens during the day, but they will open $20 less than they closed the day before. So just recognize that. Don't be concerned about that when you see it, but that's what's going on. Okay. So we got Derek here. He says, any chance a handful of those on the bubble stocks are top 10 in an ETF? Be a way to simplify without completely losing exposure to something you still like. No, that's a great point, Derek. I need to look at that. I really have 2 ETFs at the moment that is VU is one of them, which is the Vanguard S&P 500. So we know that the top two are Microsoft and Apple. That's one of the reasons I don't have Apple anymore in my portfolio, is I do have exposure to it. I've got about 30% of the portfolio in VU. So, I do have a pretty decent exposure to Apple. I didn't feel that I needed to add any more to the portfolio. And then I have SOXX, I call socks, which is it's a microchip. What is it called? But anyway, you get it. It's Intel and ASML and Texas Instruments and all of those guys, the chip technology companies. So those are the two that I have, and so you may be right. There may be some that I need to look at a little bit closer. That's a great point, my friend. I appreciate you bringing that up. Blue collar bullion baller. It's great to have you, my friend. Hello to you. We are currently at 8:55. I don't see any more questions out there. So I think I'm going to go ahead and end the stream and get back up to watch Monday Night Football. I don't know what the score is. We'll get this one other one here before we do. I like Peter Lynch. This is Jim. I like Peter. Oh, let me do this. Oops. There we go. That's much better. I like Peter Lynch was the Will Rogers of stocks. Yeah, that's probably true. I never met a stock I didn't like. I got 47 holdings down from 125. That's good. Yeah. And it's easy to do, right? Because at least the way it was for me, is that I would find a stock that I liked. It was a really good price. And so I would nibble and I would get a little piece of it. And it would be 0.3% of my portfolio. And then all of a sudden it would run up. And so then I'm sitting there with an investment that's only 0.3% of my portfolio. What I have decided to do moving forward is that if I'm not willing to put at least 1% of my portfolio in it, I'm not going to buy it. Because I want it to be something that is meaningful to the portfolio. I don't want to have these little nibbles in there anymore. So that's kind of my first attempt, is to get rid of the nibbles. And if they've really shot up so far that I don't want to buy anymore, then I may need to just drop those and move on, because they're such a small percentage of my portfolio. And I like Drake. I like your suggestion of looking at those ETFs that I have. That's really good. I'm sorry. We were talking about Will Rogers and having 47 holdings down from 125. So Jim, that's fantastic. You've made a lot of progress there. I think 47 is at least for me. 42 is a little unwieldy. So I'm still trying to get down even from 33, but I like what I have. So that's kind of a bit of a problem too. I do like what I have. So, we'll go from there. So, Kevin, thank you, my friend. I appreciate you joining the broadcast. Everybody, I look forward to these things, and I'm going to be still traveling next Monday, but I do plan to have one if I can get everything set up right. We'll be actually at the beach in South Carolina on next Monday. I'm in Ohio this week. So, world traveler here, but I take my camera, my light, and my computer and microphone with me wherever I go. So, I can do this. And then I will have a video on Saturday. It might come out a little bit later because we're driving back to Alabama on Friday. So I'm probably going to sleep in a little bit on Saturday. And so I'll have a video on Saturday. We'll have hopefully a live stream next Monday, and then another video the next Saturday. Actually, the next Saturday's video might come out on Sunday because we'll be driving back on Saturday. But regardless, you'll have one that weekend. So I appreciate you guys joining. It is really a great time for me. I appreciate you being here. I learn a lot, and hopefully you do as well. Kevin, it looks like I missed your comment up here, but maybe I'll catch that in another video. So, but guys, I appreciate it, and I will see you on Saturday.